Okay. Okay, so I forgot to tell you that the PowerPoint presentations that are posted up on the website, I follow the PowerPoint presentations. So if you you can't read, the scribbling on the board, you can listen to the audio and then go through the PowerPoints because they basically track with them. So I think that's a nice feature too. So I'm going to waive the take-home final because what I want to do is right when we get back, and I push the deliverable not to next Thursday but the following Tuesday, because I figured you might need a little extra time to work on it. And it doesn't really matter to me if I get it on Thursday or Tuesday. Okay, so just to give you a little bit extra time. But what we're going to want to do is to use that time to work on the presentations. Okay, and what I'll do is I'll send you around copies of the presentations for you to take a look at. And you can take pictures of these if you'd like to. But make sure you give me these back at the end of the class. And I'll have some others for you too to work from. But at least you can get kind of an idea of the quality that we're really shooting for on these pitch books. Okay, because these are going to be, these along with the memos and maybe some other materials that you put together in your other classes will be the portfolio of work that you'll be able to show your employers. Okay, because a lot of students come to me and they say, well, Professor Susan, I really don't have any work experience. So I work with them on their resumes to get the work experience on there that they do have. And then between the memos and the pitch books and maybe some other stuff, that becomes the portfolio that you can then bring with you and give them as samples of the work, type of work that you can do. And they will look at your work experience, your school experience as work experience, if you can show them some good stuff. Okay, so this is the quality of work that I'm striving to work with you to be able to produce. And these are some of the best presentations from my students. And I worked really closely with them to get them to this quality. The actual material needs to be a clear cover, and the cover and the spiral binding along with the black back will be provided. You can get it at the print shop. Okay, so I called them up. I think it only costs like $7 or $8 to produce it compared to 20 or something at Kiko's. But it's got to have a clear cover, not an opaque cover. He did accidentally last semester order the opaque covers, and to me it just doesn't look as good than a clear cover when you look at them. So I was really looking for quality work where the person who would pick it up, either a senior executive of a board of directors or an investment committee, would pick it up and go, wow, this is a really beautiful document. I want to start flipping through it. So it basically sucks them in. So it's got the logo, and what I'll do is I'll walk through the whole presentation. It's no more than basically 15, 16 slides. I'll walk you through and I'll train you on the valuation process. I will bring Sarah Vitale in from the library, who's a reference librarian for business. She will teach us how to get to the financial ratios and the financial data, and then I will work with you and show you how to take that data to basically do the valuations, okay, and how to use the resources available to you to put together the presentation. So I think it's a great exercise. What we'll do is I'll start the training after the deliverables due on that Tuesday, and then we have the final day, and then the last 2 weeks prior to the final will be when you're making your presentations. So you'll make Goldman Sachs first, and then you'll do JP Morgan. The presentations are no more than 8 minutes, 8 to 10 minutes, 2 minutes Q&A, and then we'll spend that week breaking up. We'll already be broken up into teams because you will have worked together, teams of 3, and then you'll come in professional dress, and you'll do a professional presentation. Okay, and I'll be working with you over the month, basically, making sure that the data and the approach and everything is correct, because some of these people that you show it to may know about the companies and may know the numbers, and they'll know if they're right or not. that's key is you're going to have to determine who's going to be the leader in your group, who's going to head up the financial analysis, so who's going to be your financial analyst, and who's going to be the production manager. Because you need somebody to really focus on the production of the document, somebody who's focused on the finance, and the leader who can basically project manage the project. You'll all be working together probably on a lot of the aspects, but you usually need some designated people to have a responsibility and accountability for those certain segments of the project. And then I will be available either by phone, email, or text. If you're conducting the analysis and you're reaching any bottlenecks, you can call me, you can text me, and I'll respond to you instantaneously to get you the information or the answer that you need to be able to move forward. On the first day of the presentation, you want to make sure that you have a really strong person to open, to basically come out and make the recommendation. And you need a really strong person to basically be able to close the recommendation. And then you'll need to practice the presentation so you can time it and get it down to that 8 to 10 minutes and make those transitions between the speakers very fluid and look really easy. Okay, so there's an art to a lot of this stuff. Okay? So you really don't want to be reading from the slides. You want to be talking from the slides and using the slides as basically the hitting on key things, being able to move through the presentation pretty quickly, pretty fluidly. Okay, and then you'll need to be in business dress too to start practicing doing these presentations. That will also start practicing for your interviews. Okay. So we're going to focus the last third of the class on the presentation, and we're going to be doing Goldman Sachs and we're going to be doing JP Morgan. Okay, which are two of the top banks in the world, actually. And then again, I moved the deliverable 2 to May 2nd. And over the next few days, we'll be working on the midterm problems and the homework problems. So hopefully those will help all of us out in moving through the material. Any questions? No? Okay. So the chapter 16, this is one of my favorite chapters. It's on capital structure for the firm. So basically, how does the firm basically structure the liabilities to finance the assets? And if they do a really good job of optimizing the capital structure, it will lower their weighted average cost of capital, which will maximize the value of the firm. So the goal for the controller and the CFO, along with the CEO, is to manage the liability side of the balance sheet to really push down and minimize the weighted average cost of capital. Because if they can get high internal rates of return on their assets and low weighted average cost of capital on their liabilities, they can maximize that spread, which is the main determinant in creating shareholder value and maximizing the share price. And so what we'll go over today is the Modigliani-Miller hypothesis. There's two propositions. Proposition 1 is theoretical, but proposition 2 is application. So we'll get into the assumptions, we'll get into the calculation of the returns on equity, we'll talk about the costs and the benefits of the debt, and why the incentive by businesses to use more debt is due to the cheaper cost of the debt, because corporations can deduct the interest on the bonds. So there's a tax shield, and that lowers the cost of the debt. So corporations end up using more debt because of that tax shield. But the problem is that if they use too much debt, the firm becomes over-leveraged, and if they go into a downturn, they won't have enough earnings to pay the interest on the bonds. The bonds will go into default. The bondholders will sue the company. They will force the company into bankruptcy and to sell off the assets so that the bondholders can get paid. And so there's an optimal amount of debt that maximizes the value of the firm. But if you go over that, your cost of debt, your cost of equity goes up significantly, your share prices and your bond prices go down significantly, and the value of the firm goes down. So the management tries to do a really good job of targeting that optimal capital structure and then maintain it over time. So we'll go through that. There's a couple other theories I'm not going to talk too much about, which is the trade-off theory. When you're a public company, you're constantly looking at the balance sheet, and you're saying, we really need money. Do we get the money by issuing stock? Do we get the money by issuing bonds? Well, if we have some leverage capacity, we can issue the bonds. If we've maxed out our leverage, we're going to have to issue equity. If we have too much debt on our balance sheet, we have to issue equity. So there's always a constant trade-off between do we issue debt and equity to try to balance and keep that target capital structure in place. Then the pecking order theory basically says you pick what you're going to issue. Now, most companies, when they go initial public offering, will start with an equity issue, of course. And then what they'll do is they will lever up, issue some bonds because it's cheaper than issuing the equity. So then they will issue debt. And then at some point in time, if they deployed the capital correctly and generated cash flow growth rates, then the stock price is going to go up, those debt levels are going to come down, and they're going to issue more debt. So they'll issue equity, then they'll issue debt, then they'll issue equity again, and then they just go over and over again. So there's a mix, of securities on the liability side that finances the assets. And the two main sources of capital are debt and equity. And I would just throw preferred stock in with the equity because it's categorized with the equity. The common stock shares, in most cases, have multiple classes. If they're a Class A stock, they have voting rights, and other types of classes may not have voting rights. So Facebook is a perfect example. Zuckerberg just wants to issue more equity, and he doesn't want to issue voting rights shares. He wants to do non-voting rights shares because he wants to control ownership and control the company. He doesn't want to be diluted, and he doesn't want institutional investors and others telling him what to do. So we'll see how that goes. So remember, at some point, if you have very high debt loads in the company or very high leverage, it's going to negatively affect the value of the firm. There's different types of debt. There's secured debt where there's assets that are pledged as collateral for the debt issues. There's unsecured debt, which is based on the balance sheet strength. You got convertible debt that can be converted into preferred stock or common stock, and then there's non-convertible. Preferred shares, you have cumulative, so the preferred shares will pay a dividend. If the company doesn't have enough money to pay the dividends, they will accumulate in heirs, and then when the company has the money, they can pay the shareholder all back dividends that they owe. Some are non-cumulative, which means that they don't have enough money, they're not going to get paid. And then non-convertible or convertible preferred. You can buy convertible preferred stock that then can be converted into equity. So really the goal for us is really to find the optimal capital structure and then make that the target capital structure in which we make financing decisions around. So the goal is to target the capital structure that minimizes the weighted average cost of capital and maximizes the spread between the internal rate of return and the weighted average cost of capital. And when you take that spread on a dollar basis, it's called the economic value add, and it's called the market value add. Now, we don't have an intermediate corporate finance class here, but if you were to take, if we did, we would be really looking at capital structure and capital structure theory, and you would spend a lot of time on it, even more time than we are going to. So if you can minimize your weighted average cost of capital by knowing the amount of debt that you need to leverage at some target or optimal level, it's going to bring down the weighted average cost of capital in the firm. And that divided by the free cash flow, the EBITDA or the earnings, is going to maximize and push up the value of the firm. So if you can issue the debt, it's going to lower the costs to a point. It's going to reduce the WACC and cause the present value of the firm or the value of the firm to go up. Same thing under the Gordon growth model. And again, if you're lowering the cost of capital, 1 divided by the cost of capital, it's going to cause the multiple to go up. The multiple times the cash flows, it's going to cause the value of the firm to go up. Same thing on a discounted cash flow basis. We can lower the discount rate, it's going to push up the present value of the future cash flows. So firms are really focused on this. So under Modigliani Miller, there's 2 propositions. There's 1 and 2, okay? And the 2 is the one that's relevant. Proposition 1 basically says that the decision and the capital structure has no effect on the value of the firm. Assuming that there's no taxes or information costs or financing costs. But if you do include these, then the amount of leverage in the capital structure does have a direct effect on the value of the firm. So you can finance your firm with 100% equity. Newly IPO'd or new firms that are in their early stages of development will probably have moved from 70% equity and 30% debt to 70% debt and 30% equity. So if you look at the firms that trade, publicly traded firms on the New York Stock Exchange, the average capital structure for the firms on the exchange use 70% debt and 30% equity. So that's like a benchmark. Then if the firm is more conservative, they would use 60% debt and 40% equity. Sorry, 60% debt and 40% equity. And if they want to be really conservative, it would be 50% debt, 50% equity. Sometimes you do see firms that have 60% equity and 40% debt. That basically signals that the company's under leveraged and undervalued. So that's another metric to be able to identify undervalued firms. To get to the expected return on the equity, you can use the capital asset pricing model. But what we do is we use another measure, which is the expected return for the company is going to be the return on the assets plus the value of the debt divided by the value of the equity, so the debt to equity ratio, times the return on the assets minus the cost of the debt. So obviously, as you increase the value of the debt, yes, it's going to increase the cost of the debt, but you could be increasing the return on the equity if you're using the money prudently and you have leverage capacity. And again, remember that the interest on the debt is tax deductible. So there's an incentive by firms to issue more debt because of that deductibility. Again, it contributes, that tax shield is basically cash back in your pocket. And I'll talk a little bit about that in a minute. So at the top end of the income statement, that's the business risk. And as you start getting into the interest expense, that's the financial risk of the firm. So there's a couple scenarios. You have a firm that has no financial risk, very low leverage compared to high leverage. And if you go into a downturn, scenario, the NOI is going to obviously drop significantly less for firms that have no financial risk and very low leverage. Once you start to take on more leverage, your cash flows in a downturn start to decrease very rapidly. So there's a leveraged effect. When things are good and you're using leverage, your cash flows are going to grow exponentially. When things go bad, they're going to deteriorate exponentially. And when you use debt too, it makes the cash flows more volatile, therefore it makes the stock price more volatile. So as you take on excessive debt, your cash flows and your stock prices will become more volatile. So a way to look at it is to put the return on the equity on the y-axis and the debt to equity ratio on the x-axis. So this is your degree of leverage right here. So you have the cost of debt, which is always going to be lower than the cost of equity because of the tax shield. And at some point where the cost of the equity basically flattens out and the cost of the debt before it takes off is going to be the point at which you're maximizing the firm. So that's going to be your optimal or target capital structure. But if you start to over leverage the firm, because managers have an incentive to over leverage, because if they do, they get a bigger tax shield. But it also, what it does is it leverages up the return on equity. So when you look at the leverage ratios compared to Goldman Sachs and JP Morgan, Goldman Sachs is over leveraged compared to JP Morgan. And you go and you look right at their return on equity and you can see that it's higher. Okay? So they're willing to take on more financial risk because they believe they have the capabilities not only to manage their business risk, but also their financial risk. And a lot of firms just can't do that. Those guys are really good. So at some point in time, when you start to issue more debt beyond where you should, your cost of debt is going to start moving up exponentially. And your cost of equity is going to start moving up exponentially. Because when people find out or realize that you're over leveraging the firm, which adds on a lot of risk, they're going to start selling your stock, and your cost of equity is going to go up. And they're going to start selling your bonds, and your cost of debt is going to start going up. And when you get into that type of scenario, the firm is in pretty bad shape. Okay? And basically, he's going to get set up to be taken out at some point. So the last piece is really the deductibility of the tax shield. So you know you have the debt times the interest, and then those interest tax shield payments are going to last pretty much forever. So you can figure out what that tax shield component is, what the cash flow component is for the tax shield, and divide it by the weighted average cost of capital to get the value of the tax shield that then gets added back to the value of the company. And then this is the debt times the interest on the debt times the tax rate. It's going to give you the amount of savings. I already talked about this. Oh, the amount of debt too. Firms and shareholders want companies to use debt because it leverages up their equity, but also the bondholders basically monitor the company and the management to make sure that they're making investment decisions, not on projects with negative net present values, but positive net present value projects. So the debt actually is a control instrument, a way to monitor the company and monitor the management, and making sure that they're doing the right thing. Okay, and then I went through this example. You can just go through it on your own. So what I did was I've answered some of the problems, and then I have some of the problems that are left to solve. So why don't you break up into groups of two. Let's try to solve as many problems as we can. We'll continue to do that in the next couple days after this. Get the deliverable 2 done, work with each other on the problems, all out the solutions to work with you, and then we'll spend the last 30 minutes of the class, going over the problems, addressing any problem issues we have. Yeah, I can do those while I'm working with everybody. So what I would do if you can, pick 2, and then if you get through them, pick another 2, and then we should probably have all. Okay?
Do you want this camera off?
Yeah. Thank you very much. I appreciate it.